The US Federal Reserve is among global central banks that are quick to cut rates in a bid to appease market jitters as investors digest the economic repercussions of the COVID-19 outbreak. Even as its 50 basis point rate cut came earlier than expected, analysts see more Fed easing on the cards.
The Fed will further cut rates again in the March policy meeting and also in the April meeting. So 50 basis point more rate cut. I think the objective is to stabilize the financial market, ensure that there's enough liquidity in the financial market and given the recent spread widening.
But the Fed's preemptive move has only heightened fears that an economic slowdown is up ahead. The Dow Jones Industrial Average remains on a volatile ride after suffering its worst week since the global financial crisis in 2008. The index fell into correction in late February, but has seen rebounds amid news of fiscal stimulus to combat the coronavirus.
We could actually see a more prolonged effect because right now the infection cases have way surpassed what we have saw from the SARS outbreak. And right now we are talking about 90,000 cases. If they really were to report a real outbreak coming to the US, chances are we'll probably see the next wave of sell-off, and that by itself will actually affect the global markets by itself.
Analysts at CGS-CIMB expect a bleak path for equity markets in the coming months. In past epidemics like SARS, some markets saw declines of around 10%. With market dynamics now more intertwined and China an economic powerhouse, equity sell-offs could be just as deep.
The STI actually crumbled around 12% from the start of the SARS outbreak back in November of 2002 all the way to April of 2003. If this coronavirus is actually similar to what we have seen back in SARS, we could actually see a worst-case scenario of 12% sell-off for the STI using the 21st January price. That will actually bring us to a worst-case target of around 2,800 points to 2,850 points.
Aviation, transport, gaming, and those with big exposure to China have been casualties of the weak market sentiment so far.
Companies like dairy farm or even Yangzijiang that has operations in Hong Kong and China especially have seen major sell-down. We also see companies in the transport sector, names like SIA, SATS, and even ComfortDelGro, share price coming down by 10 to 20% year to date.
While Singapore's Budget 2020 may provide support for the consumer sector, corporate earnings in the hospitality and aviation segments will likely remain under pressure.
The entire environment is still very challenging, so whatever that the government is actually helping may be just adding to just 1 to 2% in terms of help in terms of earnings. So SIA earnings actually came down quite a fair bit during SARS period. For this round, we think that the impact could be more severe, so we're expecting probably 2 quarters of losses.
That aside, some analysts say there is a silver lining once the coronavirus outbreak is perceived to be contained.
During previous instances of health outbreaks or health scares, the market has rallied within about 90 days of the worst of the situation. If you go back to SARS in 2003, the market was up 18% from the bottom of the SARS crisis, or the worst of the SARS crisis, so to speak.
If you look at the MSCI China equity market, it bottomed around April 2003 when a number of daily new cases in SARS during SARS period peaked. And after that, within few months, we saw 20% rally in Chinese equities. So this time around, again, the number of new cases have peaked in China, and that's why we are seeing a recovery in China's equity market. And I would expect the same to happen once the new infections peak across the world.
Until then, investors would be well placed to have a diversified strategy.
It makes sense to stay in equity market because markets have corrected by 7 to 8% over the last 1 month. As soon as the coronavirus is under control, I think market could start to bounce back. So stay invested, and we advise investors to aggressively enter the market once the virus number of new cases peaks.
Investors need to be aware that we are at the tail end of a decade-long bull run in the equity markets. irrespective of the virus, investors need to expose themselves to a diversity of assets or possibly understand that they need to have significant exposure to government securities, assets which have a lower risk profile than the equity market in a context of this nature.
For CGS CIMB, turning to safe havens could give investors some much-needed shelter.
The low interest rate environment, that is definitely very beneficial for both the safe haven asset class, specifically your treasury bonds, and as well as gold.
In the Singapore space, large-cap real estate investment trusts, telcos and technology plays also offer potential gains.
We like AREIT. We also like names that have actually have become more attractive, like Capital Mall Trust. On top of that, companies with firm earnings growth and customer demand in the pipeline, names like ST Engineering, Venture. We like telcos, mainly because of the yield, 5-6%. I think it's quite decent, and it is considered as a defensive sector as people continue to use mobile service, and that would actually be the catalyst for firm earnings.
While the coronavirus outbreak could take a toll on global economies, experts say its impact on equity markets will likely be temporary. Still, investors need to brace themselves for more headwinds that will likely come from weak economic numbers and the upcoming US elections.